Research process is based on, first of all, screening the universe. So I have thousands of stocks in my universe that I'm looking at. And how do you cut through all those? I can't call management teams at 5,000 companies. So we apply some screens up front. Some easy things like positive earnings revisions. So the company was supposed to earn $1 per share. Analysts moved that up to $1.10 per share. And then they moved up to $1.15 per share. Something good is going on, that earnings estimates are going up. So that becomes a stock I'm interested in. I don't run out and buy that stock, but that's a stock I want to do some research on. Same thing with rising relative price strength. That's a long worded way of saying the stock is outperforming the market. So somebody's buying that stock. The stock's starting to go up more than the general market, or it's falling less fast than the market decline. To us, that's a potential clue that something is going on positive, and we want to make some phone calls about that company. So what we do is we talk to the CEO, the CFO, we talk to those analysts at the different brokerage firms. We try to sort through, well, what's going on with the company, what has changed. We want to identify some sort of change that's occurred. Again, that could be that new product launch. That could be a new visionary CEO. That could be an acquisition they have made. That could be their competitor went out of business. Whatever it is, that's going to lead them to having higher earnings growth going forward than they have in the past. And the market hasn't figured all this out yet. Because if the market's figured it out, then it doesn't matter that things are getting better. It's already priced into the stock. We need to find it before the market has priced that change into the stock. And the stock market is very efficient. It's not totally efficient, which is why we can exploit some of these things. But just being slow by a week or two and figuring out what's happening in a company can make a big difference. You might miss out on 10, 15% return on that company. And that might be a return of that year. So it's really important to move quick. So the other thing we spend our time on is building a portfolio. I can go out and pick a bunch of stocks I think are pretty exciting and have the opportunity to be great, but I need to construct a portfolio that makes sense, that works together. For example, I don't want to end up buying only technology stocks, because then I'm taking a risk on behalf of my client that maybe is not appropriate. So remember, they're going to compare my returns to a benchmark like the Russell 2000, 2,000 small cap stocks, or the S&P 600, which is another small cap index. And so if I have my whole portfolio in technology, and technology ends up underperforming, I could have a return vastly different from the benchmark that they're targeting. And that can be a problem for me and for the client. So we monitor where our industry rates are, where our sector rates are, and we look at all sorts of different risks. It might be liquidity risk. So for example, we're buying these small companies. Let's say I go out and buy 500,000 shares in XYZ Corp. And it only trades 5,000 shares a day on average. I change my mind and I want to sell it. It might take me 3 months to sell that position. And with me trying to sell it every day for 3 months, the stock price is just going to go straight down. So we have to be very careful about things like liquidity. We have software we analyze our portfolio. We look at correlations. Sometimes correlations maybe we didn't notice. Like, what's the correlation on every stock in our portfolio to the price of oil, to the U.S. dollar versus the euro? Because we may have unintended bets in our portfolio that could end up turn out biting us later. So portfolio construction is really important in building and managing a portfolio like this. It's not just picking stocks.